Hello, fellow traders and investors. My name is Lee McFarland from Kinship Investments. It is October the 30th, 2017, and we're reviewing our week previous. So before we begin, I really want to thank all our viewers that have been loyal and watching our progress for the last few months, and I truly appreciate that. We started with just a couple of viewers. I think my son maybe was one of them, and we've now grown to in the double digits and hopefully soon in the triple digits. But we send our reminder videos to people that have expressed interest in what we're doing as trading and or as a business, and we try and make this series interesting for you, the viewer, in whatever capacity you're from. But really, like I said previous when we first started, this is a almost a record of my own journey as a trader and as a business person, controlling money and making a good profit potentially. So again, thank you very much, and let's get to the review for the week previous. So we did fabulous for the week. We try and anticipate about a 2.5% per week return. That's our goal in regards to what risk parameters and what risk on credit spreads we do have. And we're up until the third week of October, we're at 7.58%, which is hitting those marks pretty close. And last week we had a shock to the upside, so we ended up the week at 16.32%. So with credit spreads, you anticipate that you may have shocks on either side, but you have to take the risk associated to that to mitigate those in a way. And in my belief, I think I was a little too overweighted in natural gas for credit spreads. And to put it in perspective, this doesn't mean that we're in danger of anything, but let's say, for instance, you have a put and call, and you've sold the call at 15 cents, and you sold the put at 15 cents. And over the course of a week or two, both of them deteriorate in cost due to the sideways movement of the product to 12 cents each. Well, at some point in time, the underlying may in fact go down in price, so that the original put value is now equal to what you sold it for, so at 15 cents. Well, your call may now be worth 10 cents. Now, overall, this doesn't mean that this is now riskier position that you're in. Not at all. It's a position where you're managing, and you've made money along the way, but you have to manage these movements. So this is in fact what happened last week and leading up to the last week, where right now all of our contracts on the put side for natural gas are a little less than what we sold them for, which is great. And our calls are substantially less than what we sold them for. But on Friday, you might have a shock movement of down 4.5%, giving back some of the gains for the week. And you have to expect that. And even though 4.5% down day is a good smack in the face, it's the give and take that you have to anticipate when you're a credit seller. So another thing we want to express is last week was a great week, not only for our returns. We also received $100,000 from a new investor, so we're very grateful and thankful for him to come on board and support us. It's huge for us. Every $100,000 adds quite a bit for revenue for a business. So we're very excited and thankful for that. And we look forward to many months of hopefully solid returns. One of the other things I wanted to get into is a good article done by one of the Canadian hedge funds here locally. One of the interesting things is I'm not sure if this is available in the States or if this is an internal research, but I'll just bring it up here, where they call this the trends at present chart. So the TAP they call it, it's trends at present, they call it the TAP chart. It does not predict the trends, and I'm just reading here. It looks at the current environment and the recent past to indicate whether our trading systems and most trend following systems would have been profitable if trends were present. So the chart here shows the TAP, the trends at present, to their market universe. So this is potentially showing if you have a trend following type system, what potential for profit you have that if trends exist. And they're just showing that. They're just showing trends exist. So if you have a trend following type system, you should be profitable more so in these types of years when it's very high. When it's very low, not so much. But what's really interesting, let's bring up that chart again. What's really interesting is that they deem that the post-crisis point in 2008, 2009 was much lower on the average. But after looking at the chart here, I would actually lower that average about 1995 or so, just because of the post-crisis in 2008, 2009, which is potentially an anomaly. You know, it's a freak shock event, right? You know, if you take that and mitigate that in a way, your average should be much lower. And I'll just draw a line where I think, you know, it should be. And so it's been a slow transition from the 70s, 80s into the 90s, starting to really decrease in the amount of trends that exist. And then in the 2000s and 2010s, same sort of thing where they're very, very low. And you see that in a lot of hedge funds where they're just not able to capture those big trends. And it's interesting because they've done the research to kind of show this in a chart, which is fabulous. I find this really amazing, really interesting. So let me read a little more, and hopefully it gives us a little more guidance here. So it says, since 2009, there has been a shift down in the TAP measure, so the trend at present measure, which coincides with the real world results that many managers have experienced since. The increased TAP scores in 2010 and 14, that's the spikes there, align nicely with the positive performance experienced by XXX, that's just the name of their firm, and most of the managed futures space during those years. Recently, the TAP has certainly been running dry. Ha, ha, ha. Ooh, that's pretty bad. Okay, so what's again interesting is that I find this very fascinating because we have a main system ourselves, so which we don't run currently because we don't have enough funds for it. And when we do, we'd run them internally for a while. But as a bit of a background, we have 8 years of forward history with this, and what that means is not back tested from yesterday. It wasn't back tested from last year. It was forward tested from 8 years ago. So that means every day from 8 years ago, we were walking forward day after day, monitoring trades, monitoring results, these sort of things. That's what you call but walk forward. And if people are testing trades out and testing their strategies out, that's what you do. You may use back testing, they call it, with certain software to kind of fine tune what your thoughts are with particular trades. And then you have to walk forward with that year after year after year. And what I find fascinating is that you know, even big funds, managed futures funds, hedge funds, CTA funds, they don't inherently understand that you need different short, medium, and longer term strategy to fully diversify themselves, because because any type of market will eventually change. So the trends that are inherent within these particular, the top chart here that you see, what time frame is that? Is that on the longer term, the medium term? So these are the questions you have to ask too. The top trends at present may be better in the shorter term. So you can get more profit out of the shorter term trades. And then when there's more trends at present, you have maybe your medium term systems, which look at longer term trades with the profit and loss of your stops and whatnot. They're a little farther out than your shorter term trades. So these are the thoughts you need to have when you're building systems, which you have to ensure that they're diversified within a changing market. And every market changes. So what is your strategy to employ when markets change? And this is really important to understand when you're building systems, and you have to have a robust system that that can move with the markets. And what I found really interesting too is that with our future system is that we do have shorter term trades and we have longer term trades. And earlier on from 2010, I think it was 2010 to about 2014, I think it was, we had great success in the shorter term trades. So the shorter term trades would really be profitable. And then there was a shift almost, if you will, in the markets. And this is a diversified system from crude oil, from the S&P to gold and silver and natural gas and copper, those sort of diversified portfolio, where the medium term trades, which have a longer outlook, are more successful 2014 onwards. So these sort of interesting patterns will happen, and you should try and employ systems which use not just a few day trades, but also longer term, or else in the shorter term as well. So you have so you kind of take care of getting on board with longer term trades, as well as taking advantage of shorter term trade movements. And you'll find it very surprising if you take the same sort of principles with a medium term and you apply them to the shorter term, but shrink the risk profile in that regard. So I've made a long enough video at this point. Like I said previous, I really thank you for visiting, and we move into November with more capital and more challenges, I'm sure. Take care.